Good afternoon, everyone, and welcome to the first of our webinar series, Ask the Experts. My name is Luciano Stasi. My counterpart, Andrew Fahey, will be leading up this first webinar. And before we begin, we just want to say a couple of words about platform specialists and ourselves. Most of our leadership team started their careers at boutique consulting firms, and then eventually most of us ended up at Big Fours. To be honest, after the Big Four experience, Platform was formed really just to get back to serving our clients in a more nimble fashion and really with a greater focus on long-term partnerships for our clients, something that we felt had strayed away through all of our other experiences. Our bread and butter here, so to speak, is enterprise and high growth companies. Since the overall team has a really good mix of both functional and technical knowledge, we're able to really hone in on that. My background is a testament to that. I'm a CPA who started heavily in tax and audit as well, so I more or less know financials inside and out. After nearly a decade of building consolidation solutions in the EPM space, I'm also really deep on the technical side and have experience and certifications in both on-premise and cloud solutions. Andrew, my counterpart, as I mentioned before, has a similar background, but I'll go ahead and turn it over to him to introduce himself.
Hi, I'm Andrew Fahey. I'm also a solutions architect with Platform Specialists. I came into the consulting world from the investment finance world, so I also have a strong background in finance as well. I started out primarily on the consolidation side of our business, working with our larger clients, needing complex logic for cash flow, non-standard ownership, and really all sorts of requirements. Over time, though, I've also led projects on the planning side of the house, working with our clients on their forecasting, budgeting, and even analytics functions. So this kind of dual experience across the practices allows me to better see how they fit together to give our clients a nice cohesive solution. Over the past couple of years, I've really been focusing almost exclusively on the Oracle Cloud suite of tools, which includes their consolidations tools, their planning tool, and account reconciliations as well. A bit more about us. Today we'll be talking primarily about consolidations topics. You can see on the screen here some of our specialties, whether it's cash flow, non-standard ownership. We pretty much have seen it all when it comes to the consolidation space. But we don't stop there. We also do planning and budgeting work. As you can see, this spans workforce planning, product planning, P&L planning, so on. We've done work for clients across pretty much every industry at this point in consolidations and planning. But recently we've done a lot of work in the hospitals and medical device industries. So if you're working for a company in these areas, we have a lot of deep expertise on how you run your businesses. At this point, I'll turn it over to Luciano to go over our topics for today.
Perfect. Thanks, Andrew. So during today's webinar, we're going to answer three in particular: multiple reporting scenarios and whether they're really needed, how to more easily integrate new acquisitions, and last but not least, tips and tricks to help shave time off your close in HFM or FCC. So I'll go ahead and kick things off with our first topic of the day, which is multiple reporting scenarios and whether they're really needed. This is really specific to HFM on-premise applications. While it may correlate to FCC, the disadvantages of multiple scenarios on-premise don't necessarily correlate the same way to cloud implementations. So for today's example, we're primarily going to focus on merging the actual and pro forma scenario as one. In today's world, many companies have focused on hyper-growth strategies, which are commonly through mergers and acquisitions. And mainly because of this, an increasing need for really a pro forma or M&A, mergers and acquisition scenario, is often needed, both for filing requirements and often just to help drive how to really run the business. So a pro forma, for anyone that may be unaware, is a financial view of a business that allows you to report as if the acquired or divested company was owned consistently across periods. So you may be saying to yourself, well, I have to do that anyway, right? I now bought this company and I have to fit them into my financials. And while that's true for actuals, primarily on a prospective basis, because you can't report data that you've owned prior, and that's where pro forma or M&A scenarios come in. Within pro formas, as I was just mentioning, the financial data of both companies is blended together for a series of periods and years as if they had always been owned and operated as one company. This provides views for both the reporting and other teams into the financial operations, results, expenditures, and the like to go ahead and really make educated decisions on how to drive the business forward. It also provides enough analytics for driver-based and other planning solutions. So with that being said, let's go ahead and review some of the benefits to merging scenarios. When merging multiple scenarios in HFM, it helps not only reduce the application size, limiting the duplication of data, but it also reduces the need for rules to copy data across scenarios, which in turn improves performance. It also increases the end user visibility and streamlines reporting. This is all because we stay within the same scenario, and then because we're staying in the same scenario, it reduces IT's maintenance or burden really on their side to copy actuals into an alternate scenario as a starting point, validating across, and making sure that you have the same starting point at the very least. And so that leads us to our solution, which is really to leverage the custom dimensionality within HFM to split the sources of data. So this is primarily accomplished through using the data source dimension that would have mutually exclusive hierarchies. In the following slides, we'll see data across two rollups in particular within the same dimension, as I'm mentioning now, data source. One in particular is going to be our actuals or total external reporting view, while the latter will be our GL pro forma or total pro forma reporting view. Now, in order to achieve these multiple views of data, we first have to load our data, as we can see here, to our member GL pro forma. This member in particular represents the year-to-date data of the merged or acquired company for all of history. So as you can see in the picture here over to the right, we currently have May to August data, year-to-date in particular, for Entity 1. Now, when I say all of history, this is often determined by the availability of data during fact-finding sessions, something we'll discuss a little bit later on with other topics. In our example today, we're going to focus on Entity 1, as we can see here, which was acquired in July 2020, but was formed in 2017. For purposes of the webinar, we are only going to show 2020 results, but note that historical data pre-acquisition and merger is also loaded to GL pro forma. This provides a historical view of Entity 1 as if it had always existed within the same organization. Now, I mentioned a bit earlier that we cannot externally report as one company. So the GL pro forma data we see here, which is May through August, needs to either be ignored or parsed in some way when externally reporting this data. So as I move on to the next slide, we now see here our total external reporting view, which in particular has a member called GL Cur. This particular hierarchy does not have GL pro forma within it, and in turn only represents the acquisition forward data that is truly wholly owned. And so in this example now, for this alternate structure, we can see that May and June are 0, while July does have a $500 value. And so we're probably saying to ourselves right now, how did the 500 get there? Why are prior months 0? I'm not sure I fully understand exactly what's going on here. Well, I like to drive this home by going to the next slide where we'll see both sides. As we can see here, above, we have our total external reporting view, which is really our actual scenario historically. Below, also within the same exact dimension, we see our total pro forma view. This would be our pro forma or M&A scenario as we would have had it historically, but both being within the same dimension and within the same scenario, which is actual here. And so let's go ahead and view the data. Again, noting we have May to August for purposes of our example today, and Entity 1 was purchased and acquired in July of 2020. Therefore, we first load our year-to-date results to GL pro forma. And yes, we do have January to April results, but by May we had 600, and we'll go ahead and move forward. From there, the system behind the scenes will go ahead and calculate the monthly or periodic shift of each month within this particular pro forma hierarchy. As we can see below, I've gone ahead and calculated the periodic calculation for each of the months, and July in particular has 500. This would be the 1500 year to date of July minus the 1000 year to date of June. HFM inherently does this behind the scenes and does this month by month, scenario by scenario. This 500 is then transferred through rules and properties behind the scenes that note that entity 1 was acquired in July 2020 over to GL Cur. So again, that is going from GL Pro Forma and copying that to GL Cur. And so we could see the 500, which is not only our periodic shift in month 1, but also our year-to-date view. The next month, the system will do the same exact thing. It will calculate the periodic shift, which we can see here as 750. I've also gone ahead and put an August periodic shift here to the right. And note that that same periodic shift would be the same in your actuals results. The primary difference is the year-to-date. Even though 750 is our monthly shift between August and July, that 750 then transfers again from GL Pro Forma to GL Cur. It is then added to the 500 from the prior month to derive a new year-to-date value, in this case being 1250. The 500 of July's monthly activity plus 750 of the current month's activity, leading us to a new year-to-date result. This is perfect for external reporting because at the end of the day, January through June results cannot be externally reported. We did not operate, we were not owned as one company in total. If you are interested in learning any more about the topic at hand, or if you have any additional questions or concerns, please feel free to contact us with additional questions following the end of the webinar. We will provide our contact information.
Thanks, Luciano. So kind of along the same vein, our next topic is about how to more easily integrate new acquisitions. We've worked with a lot of companies that undertake significant M&A activity, and we know that integrating a new company into your systems can be difficult and stressful and take a lot of time. So we're going to go through here a few things that we've learned over the years that you should consider and ask early on in the process to help make this process a little bit easier. First and foremost, we recommend that you review your existing EPM platform. If you're going to need to report out as one new consolidated company, can this reasonably be achieved in the current system using your current chart of accounts? And if not, who is going to be responsible for designing this new chart of accounts or mapping into your current chart of accounts? Now, whether the current chart is viable for use across the new merged company or not, who is going to be responsible for doing this mapping? We find in our experience that putting the right person in charge of this can make all the difference in how smooth it goes. Keep in mind that you will have separate general ledgers, 2 or more, it could be many different general ledgers, all with unique chart of accounts in different segments. So when you're considering who to put in this role, it should always be someone with a very deep understanding of the financial reporting needs of the company and the day-to-day activities of the existing company so that they can ask the right questions to the acquired company. At the same time, though, it's always helpful if this person is at least somewhat savvy in the system, because after they do the mapping, they will likely be very involved in the testing and validation of the new data, the integrations that have been built. So off the bat, one of the most important things is making sure that you have the right people in place to help lead the effort of running the integrations. After you've sorted out your mappings, you'll need to start thinking about the reporting needs that you will require from the new company. Kind of as we talked about in the last section, many times pro forma financial statements are going to be required. And if you're going to load historical data in from the acquired company from before the acquisition was made, think about how feasible it's going to be for you to obtain those trial balances for that company. One area we see significant challenges for this is when you're purchasing only a portion of another company. So it might be difficult to segment out only the portion of the business that you purchased from the portions of the business that you didn't purchase. Another area you want to think about is any uncommon or new business processes that the new company may have, and understand if you need to incorporate those into your system. This is often easier said than done, so understanding what these processes are and why they're in place, and if they're required, is very important to think about early on. Another big challenge we see is differences in the close calendar. For instance, if you're used to closing the books in 5 days, but the company you acquired takes 10 days, this is going to pose significant risk to your close calendar. So start these conversations early on so you can understand, in our example, why their close might take longer than yours, and if it's really feasible for them to comply with your calendar. This again might help you to uncover some of those uncommon business processes or identify internal delays that might impact how quickly they can close the books.
Another important consideration is multi-currency. More often than not, Andrew and I often see that companies go from a single currency to at least 2 or more overnight through acquisitions mainly. If that's the case, has anyone within the organization factored in CTA, cumulative translation adjustment, and how this is going to impact the business and financial reporting overall? Stemming from that, have you considered all the purchase price accounting entries that you might even need to layer in due to the deal? What if you've even carved out of the organization and you've now formed a new company? Carve out adjustments is something that we'll go ahead and want to think about as well. All of these things are not only items that we need to correctly file, but considerations of how we need to go ahead and incorporate in that business and who is going ahead and going to put that together. You may also have new GAAP requirements. We often see this when companies go from domestic to international. In acquiring those companies, is the international company requiring UK GAAP, IFRS GAAP, or any other GAAP requirements? Do those countries require statutory filing requirements and the like, and the list can go on and on from there. You'll also want to consider any new disclosures or footnotes related to the acquisition, and really whether or not the right place is to house that within HFM, use an ancillary tool like narrative reporting, or where this is going to be housed and where it's going to come from. I think Andrew mentioned this a little bit early as well, but the availability and format of trial balances across all of these GLs can also be time consuming and difficult. And so when thinking of pro forma reporting, as well as how to integrate this new company, which again might be 1 GL, and we've seen over 30, you'll want to make sure that you can get all of that, you can correctly get it in, and how far back can you go for pro forma reporting needs. Last but not least, and certainly not least, there's so many more items that can be discussed, but these will help uncover and really get the conversations going, is non-controlling interest and non-standard ownership. These types of things need to be built into the system generally upon inception, and something that shouldn't be overlooked. For example, if you only own 50%, less or more of a company and not 100%, this then stems into non-controlling interest. And if it's something that is often done throughout the business and or may continue, you may want to consider building in non-controlling interest within the system itself.
Thanks, Luciano. So now we come to our final question, and this is something that we get asked by nearly all of our consolidations clients. The monthly close is, well, monthly, and it's a time-consuming process. So companies are always looking for ways that they can try and save time and hopefully reduce some of the late nights that the close team has to endure. So in this section, we'll go through some of our top tips for how we recommend clients make the close a little bit less painful. The first area is around task management. So this is understanding what tasks need to be completed by the close, what's the order they get completed in, and who's responsible for them. Oracle offers tools both on-premise and in the cloud to help you manage the tasks during the close. And effectively what this is taking an offline close calendar and a to-do list, a task list, and brings it into a system. So what this involves is taking that out of some offline process where you have emails flying back and forth and it allows you to easily see what the status of the close is at any given point, who's responsible for what, automatically send reminder emails to people when tasks are due or overdue, and identify bottlenecks in the close. Another nice thing about bringing things into a system is you can easily analyze trends by comparing closes from different periods. So you can easily see which steps are taking the most time, which ones are consistently late. And what that allows you to do, it gives you a good picture of which areas are the biggest pain points during the close so that you can start thinking about how you can improve those processes or even the systems that support those processes to help ease some of those pain points and alleviate the bottlenecks. Another area which can be a pain point is consolidations times. So how long it actually takes for the system to run all the business logic, to take the data from the underlying ledgers all the way up through consolidated reporting. We see clients, especially those that have been using the same system for years and years, with consolidation times that really aren't efficient. You can imagine if you just make one change to the data during the close and you have to wait 20 minutes for it to consolidate, it can eat up a lot of time over the course of a close and over the course of several months and years. So we recommend that companies evaluate their business logic every couple of years, certainly whenever you go through an upgrade cycle. But even absent of an upgrade, you always want to evaluate your business logic over time. What you want to do is identify the parts of the consolidation that are taking the longest. From there, you can work to tune the rules with performance strategies in mind to help speed things up. In addition to this, we always like to have clients go through all of the business logic that's in the system and determine if it's still needed. I've seen examples where specific HFM applications may have had allocation logic built in that might be taking several minutes to perform during the consolidation, which may have been held over from years and years ago and nobody ever looks at it anymore. So evaluate whether you can take things out that aren't used anymore. The next area we view that can really save companies time is implementing lights out data automation. The more you can automate your data integrations, the better in our view, whether that's taking a direct connection to the source system or even just automating file drops that then get picked up by the system automatically. This is always going to reduce the number of button clicks that people need to make or how much time they need moving around files, saving them here and there, running jobs manually. We always like to pair data automation with process status emails so that whoever is responsible for that data load can easily know when the process starts, when it finishes, if there were any errors, what they were, and provide some sort of error notifications in the emails, which helps you not have to dig through those logs to understand what was going on. Another huge win in automation that we've built in for clients is automated data integrity checks during the process. One example that we've utilized at a lot of clients is, for example, ensuring that intercompany accounts have an intercompany partner, or ensuring that a given account is using the correct combinations of custom dimension members. So what this does is we proactively monitor the data as it's coming in, and we can send emails to the data owner or administrator, which shows them any intersections that violate the rules that have been set up. So this really helps you identify issues proactively rather than having to get the data loaded, have someone review it, see there's an issue, dig in, find out what the issue is, go back to the source. It helps you identify them up front and really save time digging into and reviewing what the issues are. Kind of pairing with the above are validation checks. So this can take a few forms. The first one is a feature built into FDMEE and cloud data management called check reports, which allows you to display a report upon loading a data file, which can either make the data load stop or even just provide a warning. And it helps you to do checks during the data load process as well. So one easy win here is setting up a check report, for instance, to make sure that the trial balance is balanced when the data is loading in. Once we get the data in, We like to make use of what's known as validation business rules to help ensure that the data is correct before someone signs off on it. So this would be used in conjunction with process management. And one example of this might be end users need to complete an AR aging schedule during the monthly close, and they need to make sure that they age their entire AR balance. Now we can write validation business rules to say, have they aged the entire balance of the AR accounts? And if not, we populate a value in the validation account and it prevents them from submitting their data for sign off. So again, it's really just making sure that we're proactive in nature, identifying issues before people go in and review. And finally, I want to talk about data source dimensions. You kind of saw the power of this in a previous section about pro forma results. Any new system that we build, we always incorporate a data source dimension. And really what it does is it helps you to identify where that data came from, whether it's tracking various general ledgers or manual user inputs, calculations, eliminations, so on and so forth. It just helps you to better understand your data and see where it came from, and it helps you to identify issues much quicker. Moving on from that, segregation of duties and security. This is really ensuring that you prevent issues from happening before they happen. You want to make sure that your security model accurately reflects your business processes. So many times we see companies with gaps in their security model that might allow users to submit data places they shouldn't, which can result in hours of people troubleshooting and understanding why something's not right, where did it come from, only to find out that someone put data in a place that they shouldn't have been able to. Once you have that good security model in place, similar to reviewing your consolidation rules, you want to periodically evaluate this and make sure that there's no gaps and make sure that there's no issues with this. So maybe every 6 months or a year, review your security model. Another area where we find big wins for companies is in cash flow automation. Putting together the cash flow statement is never an easy process, and you can never truly get to full 100% automation of a cash flow statement, but the more you can build in, the better. Step one would be getting your cash flow out of Excel and into your consolidations tool, which is the first step in the process, taking your balances in and using your balance sheet to help create the framework for your cash flow statement. And if you do have it in a system already, making sure that you're allowing it to do as much of the work as possible. For instance, have the system take depreciation and amortization expenses from the P&L and populate the correct roll forwards in the balance sheet, rather than having to have your users key them in manually and make sure that they tie between the roll forward and the P&L. Kind of looping back to validation rules, we like to make heavy use of these in cash flow as well. So ensuring that people have properly filled out all of the roll forward schedules, ensuring that they've captured all of the activity period over period. If there's any data points that need to equal one another, that they do, so on and so forth. Again, being proactive and making sure that we can check the data along the way rather than in the final review stage. Another generally painful area in the close is account reconciliations. So a lot of companies are still doing their account reconciliations offline today in Excel. Again, you're back in a process where emails are flying around, you're saving things on shared drives. It's hard to understand where the process sits. So consider having a system-based account reconciliation tool. Again, Oracle offers versions of this for both cloud and on-premise. And what this allows you to do is similar in nature to task management. It allows you to get a better understanding of where the account reconciliations sit at any one given point. So after you build out all the reconciliations that need to be done on a monthly basis, you can easily see who was assigned which reconciliations, which ones are late, which ones are open, where do you have high risk reconciliations that are still open, things like that. You can load data in from multiple data sources, which can help you to auto reconcile balances that match. So for example, maybe we bring in the trial balance and we also bring in the AR and AP subledgers. We can set up rules where we say, if the AR balance in the subledger matches the trial balance, we can auto reconcile that. Take some of the work off the table for the end users. Not only that, we've also worked with clients to use an account reconciliation tool to help make sure that your consolidation tool is correct. So for instance, you could take in all of the trial balances that you're loading in from the source general ledgers, and you can compare those to the balances that are in the consolidation tool and auto reconcile whenever those are equal. And it can give you greater confidence that your consolidations tool matches all of the various trial balances. This brings us to our final tip, and it's generally a big one. It's making sure that you're using the right tool for the right job. Too often we see things being pushed into a consolidations tool that really don't belong there. And this really leads to a lot of times performance issues, where you're asking the consolidation system to do more than it's really designed to do. And it can also result in process issues when you're trying to effectively fit a square peg in a round hole. You really want to make sure that your consolidation system, whether it's HFM or FCC or any consolidations tool, is being used for its appropriate purpose, which is to produce consolidated financial results. If possible, you want to use a planning and budgeting tool for your forecasting. HFM can certainly handle loading in budget data, but it's really not a great place to actually plan and build your budget. It's not as flexible as the planning tools. It's very difficult to implement things like driver-based planning. And finally, leverage S-based cubes for additional calculations, analysis, and reporting. Things like alternate currency conversions, constant currency analysis, performance mix calculations sometimes can be a much better fit in an S-based application, which has more flexibility. What this does is it avoids bringing logic into your consolidation system that it's not really related to the monthly close. And we always like to tell our clients to keep your consolidation system, your race car application, you want it to be as fast as possible so that it doesn't introduce any unnecessary risks into the monthly close. So that wraps up the 3 topics that we had for today's webinar. We really appreciate everyone submitting their questions, and we hope that you continue to submit more questions so that we can answer them in a future webinar. If you have any questions about these or other topics, feel free to reach out to us directly. Thank you very much.
Thank you, Andrew. Thank you, everyone. We appreciate you joining. And as Andrew mentioned, direct contact information is here below. Feel free to reach out with any additional questions, concerns, or something that may have been said today that you'd like additional clarity on. Thank you all again, and have a wonderful day.